This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, the first bit of good news, I can promise you this is the last lecture in terms of IHT, and it's going to be a short one there, so two bits of good news. Inheritance tax planning. Now, again, what we're most likely to see in terms of IHT involvement is a question or two within Section A, of objective testing questions, and then a 10-mark exercise in Section B, which again is broken down into 5 individual objective testing questions that would usually take you through the computational aspects. But we're also going to get a 10-mark question in Section C, which is of a more planning style. And the capital taxes is something that's been tested on a regular basis and will continue to be tested on a regular basis at P6. So it's always possible, therefore, that we might get an involvement of this here at F6 as well. And in essence, it's very straightforward. What we've got to consider is the idea of succession planning. I've got some very bad news for you. We're all going to die. At some point, we're all going to die. And then what's going to happen to your assets and how will they be dealt with for taxation purposes? Now, apparently when I die, my wife tells me, apparently I'm dying first here, that all of my assets will go to her. So, need I have any concerns about any taxes arising when I die and all my assets pass to my wife? Answer, no. Transfers between spouses are exempt for IHT. We also have no gain, no loss transfers for CGT between spouses, but on death, that's an irrelevant point anyway, because there is no CGT on death. So on death, therefore, there is no CGT whomsoever I give my assets to. So there's one bit of good news about dying. Wherever you give your assets, whether it's to your spouse or more likely there in an exam question, your children, on that basis there'll be no CGT. And your assets pass at whatever is their then market value, otherwise as we've seen known as probate value, at the date of death. So all accrued gains in your lifetime, the deceased, are wiped out. They go to the new beneficiaries at market value. Now that's good news, but apart from the obvious bad news, you're dead, the really bad news in terms of taxation is IHT. Because as soon as we go above the available nil rate band and residence nil rate band, or bands as the case may be, then we're talking about a 40% inheritance tax rate. That is a very big number. Now, for most taxpayers, of course, when we combine together the fact that one spouse dies, it tends to go to the next spouse. Those transfers are without any taxation charges, CGT or IHT. And that means that when eventually the surviving spouse also sadly dies and the assets then go to the children, you've got 2 lots of nil rate band, that's 2 lots of 325, that's 650,000, and 2 lots, if applicable, of residence nil rate band, that's another 200,000. So that's £850,000 worth of estate effectively able to get through to your kids without fear of any inheritance tax being charged. Of course, there will be, in our exam and in real life also, those taxpayers fortunate enough to have estates that are significantly larger. And therefore, when they die, anything above the available nil rate bands is going to be a 40% tax charge. Now that, as we said, is a very large tax charge. So what can they do? If we're going to plan other than just leaving everything to the spouse and therefore there'll be no tax charges, if we're thinking about planning by gifting to the kids, how should we do that in order to mitigate our overall tax charge? Well, as we've seen, in order to avoid CGT, it would be best to give on death because there is no CGT. But in order to avoid IHT, we don't want to be giving on death because go above the nil rate band, it's a 40% tax charge. So what would be the best for IHT? Presumably to give in lifetime. When you make gifts to your kids in lifetime, these are potentially exempt transfers. And if you make them soon enough, then there's every possibility, nay probability, that you will survive for the next 7 years. In which case, when for IHT purposes you make a pet, you know there is no immediate IHT liability. Look here at other gifts to individuals. We'll come back to the bit in a minute. But in terms of pets, there's no immediate IHT liability will arise. And these transfers only become chargeable if the donor dies within 7 years of having made them. Live for 7 years or live for more than 7 years, there's not going to be any IHT. If the individual does die within 7 years, the value of the transfer is said to be frozen at the time of the transfer. So, if I give away an asset now to my son that is worth £200,000, and sadly, within 7 years, even within 3 years, so the next bit, taper relief wouldn't be available either. I die in 2.5 years' time, having made that gift of an asset that was then worth £200,000. If it's an appreciating asset, by the time I die, it could be worth £250,000. Well, think what would happen. The pet is the value of the asset at the time of the transfer. That was £200,000. It's that will be chargeable to tax. If I just kept that asset until I died and it was still within my chargeable estate at death, it would be £250,000 in my death estate. Now, of course, we don't always know what assets will indeed appreciate or by how much. But that concept in there, another benefit of gifting in lifetime, is known as value freezing. We freeze the value of the asset at the time of transfer, and on that basis, therefore, that will help us, we hope, to mitigate any IHT charge that may arise, and it only will arise if you die within 7 years. If you die within 7 but you last for more than 3, then as we've seen in recent examples, taper relief, of course, is available to you. Now, if we go back to the beginning of this note, as we've said, as the chargeable estate of the taxpayer is charged at 40% above our nil rate bands, making lifetime transfers is the easiest way an individual may reduce the IHT liability. To avoid IHT, gift in lifetime. As we've said, gift in lifetime, live for 7 years. You've cracked it. No IHT at the time of the transfer and no IHT when you die. Now, of course, if you are going to give away assets in order to reduce, you hope, your IHT liability by reducing the value of your chargeable estate when you die, you've also, if you're dealing this in practice, you'd also, of course, look at the taxpayer's situation as regards, has the taxpayer got the capacity to make such gifts? Obviously, the willingness must exist there, but do they have the capacity? Remember, they will need to keep assets to provide themselves with income in their older age once the earned income dries up, other than, of course, through a pension there. And that would be an important question to ask any taxpayer looking to do this. What pension arrangements do you have? But other than pension arrangements, then where's your income going to come from? Well, that presumably is your assets, your income-producing assets. It could be shares from which you earn dividends. I'd say money in the bank from which you earn interest, but there's precious little of that available these days. So otherwise, it might be a property that you rent out. But you've got to have sources of income to keep you, hopefully, in the standard of living that you would like to live within for the rest of your days. So there's a big practical question. Do you have the capacity to gift as well as the willingness? So, give in lifetime, we hope to avoid IHT there, or at least to mitigate it. But as we've said, when gifts are made in lifetime, the taxpayer must also consider any CGT implications of those gifts. We don't want to be avoiding one tax only to create another. We said we could keep everything we own till we die and we'd avoid CGT, because there's no CGT on death. But what was that going to do? We roll everything up, bundle it all up into the chargeable estate, we go above the nil rate bands, and then lose 40% of the balance in terms of an inheritance tax charge. Therefore, to avoid the IHT, give in lifetime, hopefully live for 7 years. But when you do give in lifetime, then we may have to consider, well, we always have to consider CGT. Now, a chargeable gain will arise on a chargeable disposal of a chargeable asset by a chargeable person. Again, an important communication point to a client to inform them that if they gift an asset away in their lifetime, that for CGT purposes, that will still represent a chargeable disposal. A chargeable disposal isn't just a sale. It could be a gift, as we're talking about now, It could even be a loss or destruction of the asset, issues I hope you recall from the CGT chapters that we looked at. So chargeable disposal, yeah, you give it away, it's a chargeable disposal. You might say, but if you give it away, how do you work out a gain if there's no sales proceeds? Well, that's easily dealt with. It's market value. You use the open market value of the asset being gifted. Chargeable disposal of a chargeable asset. Well, there's a possibility. Not all assets are chargeable. Some are exempt. So if the asset is an exempt asset, cash, your car, an exempt chattel, family heirlooms there, then no gain will arise. So those could be gifted in lifetime. Clearly, we will be dealing with a chargeable person. Again, these aspects are not seriously within the F6 syllabus, but basically anyone who is UK resident is a chargeable person. A gift, as we know, is a chargeable disposal with a gain being computed based on the market value. And as we've said, the gain must be then computed. CGT will be payable, subject to a taxable gain arising. If it's an exempt asset, there is no gain to compute. And even if the asset is a chargeable asset, there'll still be no CGT liability if the net gains for a tax year are covered by the AEA. Each individual has available, currently at our level, £11,300 worth of gains that they can make in a tax year, every tax year, and not pay any CGT. So you think, if I own an asset that I bought for £40,000 and is now worth £50,000, then if I give that away in lifetime, I have reduced the value of my estate by the current market value of £50,000. That could, upon my death, save me, therefore, some 40% of £50,000, a £20,000 IHT liability has been avoided there. But I've got CGT. Well, no. I've got a capital gain to compute, yes. But 50,000 market value less a cost of 40,000 is a gain of 10. If I ensure that that is the only gain made during the tax year, then it's covered by the AEA. So there is no CGT, and we have given ourselves the best possibility of avoiding IHT. Live for 7 years, you will have avoided IHT. If gains would actually exceed the AEA, then all may not be lost in terms of CGT. There may be reliefs available. For example, if it's your principal private residence, PPR relief exists, doesn't it? So if you have lived in your property since you bought it, even possibly you've been away for various reasons which are still classified for capital gains tax purposes as deemed periods of occupation, then PPR relief is available. So that would exempt a gain. So you could get rid of that. Obviously you'll have somewhere to live, but your PPR relief would be available. Or then gift relief, of course. Now, gift relief doesn't exempt a gain, it defers a gain. You go back and check out again on CGT those important reliefs. Gift relief defers a gain. When you give an asset away to your son or daughter, if it's a chargeable asset, then a gain must be computed based on market value. And then we consider what would happen for you, the donor, and for your daughter or son, the donee. If, of course, it's for you, the donor, you have a gain, and the donee, your son or daughter, would be deemed to have acquired whatever asset it might be at its then market value. You, the donor, take the burden of the charge to tax now. If you don't want that to happen, then gift relief would be available. But be careful. Gift relief is not available just because you give an asset away. Gift relief is only available if the asset in question qualifies. Got to be a qualifying business asset. Now, when you move on to P6, you will discover that there are other qualifying disposals for purposes of gift relief. But for us, it's got to be a qualifying business asset. If it is, gift relief is available. The donor can defer the gain by doing what with it? jointly claiming with the donee to reduce the base cost of that asset going to the donee, thus making them responsible for any future gain when they dispose of the asset. Now, in addition to what we've just spoken of, what you would find again useful, let me see if I can find it here. Yes, here. Chapter 26 is the chapter on tax planning style questions. The sort of what we're now seeing to be the sort of 10-mark exercise in section C. And one part of that might be a capital taxes problem. And these notes here, beginning at the bottom of page 164, where it says, we noted above the tax implications of spouses or civil partners transferring assets to one another, and that, of course, is the no gain, no loss transfers for CGT in lifetime, and exempt transfers for IHT, whether in lifetime or on death. Remember, on death, there is no CGT wherever you gift to. As we've suggested, a more interesting problem worthy of an exam question would be what tax implications arise when assets are transferred to your kids, your children there, usually by gift. Now, we refer to what we've been looking at in IHT illustration 1, demonstrated the IHT implications. But we've also got to consider in lifetime CGT. So again, though, when we see a CGT question, probably in section B, an IHT question, probably in section B, they stand alone. They just look at this one tax. In real life, we can't do that. We have to consider if an individual is contemplating, again, succession planning, considering whether to gift assets in lifetime or on death, and in so doing, which assets to give in lifetime, which assets to keep until they die, then we have to consider both IHT and CGT. And what we've then got is a little illustration here. And what I'd like you to do is to read carefully through these illustrations and examples. Again, I hope I've made the notes here self-explanatory for you to be able to understand what the issues are. To get you thinking, should you get this style of question, that you may be asked to advise a taxpayer during their lifetime about giving away assets either in lifetime or on death. And at that point, you have to consider both capital taxes. Both capital taxes are relevant in terms of lifetime gifting, purely IHT relevant in terms of gifting on death, because there is no CGT. And this little example here looks at not just the situation of computing a transfer of value for purposes of IHT, but also looks at the different valuation rule that would apply in terms of gifting for CGT, where it's the market value of what is being gifted that is taken into account in computing the gain, whereas the transfer of value isn't the market value of what is being gifted, but it's the difference between what the taxpayer owned before and what he had after the transfer. That's the IHT bit you'll read through here. This is the CGT bit. And this goes into more detail about the points that I've just been discussing. So have a little read through of these particular notes and the example there, please, all the way through, and that will take you down to the end of this particular chapter. Elsewhere in this chapter, you'll find, again, other planning scenarios that are concerned with rather more income tax and sometimes a comparison of income and corporate tax issues. So do check this out before you walk into that examination room. Again, it's only a 10-mark question in section C. Never going to pretend that we can cover everything that could possibly arise. But again, remember, in the exams, it's never in a written question about doing it all. It's about doing enough. The beauty of written questions is you can score 50%, 60%, 70%, 80%, 90%. It doesn't have to be all right. Problem with an objective testing question, which is why you've got to be oh so careful with them, is it's either 0 or 100%. There's nothing in between. You either get the 2 marks or you don't. So section C, making sure that you can do a corporate tax computation and understand corporate tax issues, income tax comp and understand income tax issues, like all the work on assessable benefits, for example, they're going to be critical in terms of your eventual outcome on this exam. So vital, therefore, that you practice. I'd also be recommending that maybe even in the exam room, you start with section C. Not with the planning style question that might give you more problems, but what should be, once you practice, more straightforward, and where you score marks for what you do, you don't lose marks for what you don't do. Work those two written questions, 30 marks, the 2 15 markers there. Make sure you exploit those. You don't want to be wasting your time on very difficult objective testing questions and then run out of time, such as you're in no position to complete these two questions guaranteed in section C, a 15-mark income tax and a 15-mark corporate tax. Those are areas you simply must exploit within the available time. The only thing that you need to be left with when there's 2 minutes to go in your exam is the odd objective testing question, potentially in section A, where you don't really have a clue about it, and go with your favourite letter at that point in time. Or if you've got a bit of time to do any workings, you might be able to narrow it down and think, well, it's not those two, so it's now 1 out of 2. Then go with your best guess. But you don't want to be doing that before you've done everything else. There's marks that you could and should score. They're the ones that you exploit. They're the ones you make sure you get first of all. Okay, so you check out this chapter. We, of course, have got one more chapter to deal with in terms of our discussions on these lectures, and that is VAT. And I look forward again to talking to you about that tax in a short while.